us start with our panel discussion. And the topic name of the panel discussion is Startups and Fund Management in Rapidly Changing Economy. I repeat, Startups and Fund Management in Rapidly Changing Economy. And for that, I would like to call Mr. Praveen Sharma. The company name is GatePay, founder and CEO of GatePay, to please come on the stage. Mr. Praveen Sharma ji. Can we have a huge round of applause? Mr. Devansh Lakhani ji, Director of Lakhani Financial Services, to please come on the stage. Mr. Sagar Gusalia, the COO of G2 Incubation and Innovation Foundation, to please come on the stage. Next is Ms. Anuradha Chaudhary ji, founder of 0 to 3 Collective, to please come on the stage and share your thoughts with the audience. Next, I would like to invite Mr. Arjun Rastogi ji, the co-founder of Nagin, to please come on the stage. Can we have a huge round of applause? And last but not the least, I would like to invite Mr. Devansh Lakhani ji, the Director of Lakhani Financial Services, to please come on the stage. Thank you, sir.
I think this is a wonderful event, to talk about startups, to talk about revenue management, fund management, and we have some good dignitaries out here. And I'm going to put some questions to them, which we can probably understand how the startup ecosystem, how the investment ecosystem, along with its legalities, is shaping up in today's day and age, right? So let's start probably with the first question as to, how can startups secure funding during, economic downturns, the way that we are having right now, or probably it has been, since the last 1 to 2 years, a little bit of a downturn. How do startups deal with that? If we can start with Mr. Sagar first up.
Thank you. So I'm surrounded by startups and I'm only the angel investor, so very difficult. Okay, so ऐसा होता है कई बार एक्चुअली कि फर्स्ट एंड फॉरमोस्ट स्टार्टअप्स को ये समझना ज़रूरी है कि उनको फंड चाहिए भी कि नहीं. आई थिंक मोस्ट ऑफ द टाइम the only objective of starting up is to get funding, but that's not the objective. So I think the first and foremost thing, और ये तभी problems आते हैं जब actually funding की requirement ना हो, actually funding का right time नहीं हो और आप fund raise करना चाहते हो. That's where the startup challenges. So I think in an economic downturn or any funding winter season, best way to do is actually first have a very clear cut plan. इन द सेंस कि आप वो पैसे का करने क्या वाले हो. अगर वो पैसे आप एक्चुअली जस्ट यू आर ट्राइंग टू गिव सैलरीज टू पीपल और लाइक नॉट हैव एनी अदर स्पेसिफिक एक्सपांशन प्लान, इट्स वेरी डिफिकल्ट टू गेट फंडिंग. सो आई वुड रिकमेंड स्टार्टअप्स टू फोकस ऑन क्लियरली द यूज ऑफ मनी. Predominantly, the use has to be expansion and reaching out to new markets.
Okay. Arjun, your take on this?
I mean, as someone who's been trying to raise money through all of this, I think you can definitely have, I mean, it comes in cycles, but I think what's really important is that you're able to convince your investor or you're able to prove to your investor that there's actually something of value being built here. Like, not every company is going to be profitable, not every company is going to be at like a crazy, sort of like growth trajectory. So I think the idea is that whatever journey stage you are at and whatever you've got going for you as a company, you have to be able to translate that over to an investor who can see how it works for them. I mean, as much as they try to cater things for us, we need to do the same for them. So I think the idea is painting a picture of how they are going to see growth, how they are going to see, their investment sort of grow. And I think there's a there's definitely a clear understanding with good investors that there is risk associated with investment. But every now and then you need to kind of think outside the box. You got to look at debt. You got to look at other options. I know this sounds really basic to say, but I think the best thing you can do is actually just manage what you have going well and start early on whatever fundraising you need to do. Because no matter how many times we do this, we still make the same mistake every time. We always underestimate how long it really takes to get things over the line. So I would say start early and figure out everything you need to know from the ground up, and that really helps the process.
I think you are absolutely right, because in my experience of helping startups raise funds, we've seen that minimum 6 to 9 months in advance is something that one must start, because it takes, I think, 4 to 6 months to close a deal. But if you start 9 months prior, your cash is going to run out. So you have a good leeway or backup that you can always consider, that you're not running out of cash or you're not dying because of lack of oxygen. So I think, yeah, 6 to 9 months is a good time. One must always look to start. Coming to, and I would like to understand a little bit from the legal aspect also, and also from a non-legal or an investment aspect, is what are the top 4 factors, right, which one must consider while evaluating a startup, for investment? So we can start with Pranav and Praveen, sorry, and then we can move to Anuradha to take the legal aspect from it.
I think I'll just come back to the previous question first, that say first, there is no economic downturn, correct? For the startups who have the business ideas, who have the expansion, there are multiple ways of raising funds, and funds are available to the eligible startups easily. There are multiple options, debt, equity, multiple options are there, bank financing, bill financing, lot of options are already available. And if you see the way we are growing as an economy in the last couple of years, and the way ahead for the next 5 years, I think funding is not a problem, which I personally feel. And as a company, we have raised multiple rounds. We are already valued at around 400 crores now. So I think funding is not a problem for EA. If say I've been investing myself into multiple startups, so what I think first foremost thing what I see when I want to invest is the founder, correct? The founding team, the most important aspect, because पैसा jockey पे लगता है ना? So I think that is the most important aspect. If I believe in the founders, I know वो पैसे बना लेगा, वो business pivot भी कर लेगा. If there are problems, things, they'll be able to do it. So I think the first foremost thing which second is the business ideas, the market size of what is available, that okay, what problem they are trying to what problem they are trying to say, are they ahead? Because I have seen a lot of startups, they were way ahead of the market and they vanished, correct? So I think you have to be say apart from your product, you have to the time to market is also very, very important. What kind of problems you are solving, I think that is also a very important aspect which I feel. So I think these 3 pointers I think puts together is the final recipe for any investment. I think if the team is good, if the product is good, they are trying to solve a genuine problem which has a market, and I think the time to market is very, very important aspect.
Okay, fair enough. Anuradha, your take, and if you would want to give some legal angle to it also.
Sure, thanks Devansh. Hi everyone, my name is Anuradha. I am the founder of 0 to 3, which is a specialized law firm for new technologies. Sorry, I really don't know how to silence this. So we work with a lot of startups and we work with a lot of investors as well. And what I've seen purely from a legal perspective, I'm a lawyer, so that's all I can offer today, is that the top things that investors look at, number one is always the corporate structure and compliance. Is the entity or the project set up in the correct manner? Do they have their documentation in place? When I say documentation, I mean their constitutional documentation, like their articles, their MOU. Are their business activities actually as provided in their articles of association and memorandum? The second thing is compliance. Depending on the sector in which you're engaged, we work with a lot of new tech like AI, crypto, gaming, which are very controversial sectors, and there's a lot of compliance, there's a lot of ambiguity in regulations. So investors do look at whether you understand the compliances, whether you are in compliance, where you're set up. And I would say the third most important thing, or rather the top important thing, is the IP. Now, if you've started a company and the company does not own the IP, investors are going to shy away. Arjun, you started Nagin, right? Imagine if you'd started the company and you'd hired a bunch, if for anyone who doesn't know, Nagin makes incredible sauces. I use them every day. But if you hired someone to create a sauce for you before you started Nagin and you just paid them generally, and you didn't make sure that the rights in the recipe were assigned to you, and when you set up Nagin, you didn't make sure that you assigned those rights that were initially assigned to you to the company, an investor will likely shy away, or they will at least ask you to sort of make sure that things are in order. So IP protection is very important. Investors want to ensure you own the IP. They want to ensure that if it's a trademark, it's registered. If it's a patent, an application is in place. So yeah, these are the top three things: corporate structuring and compliance, the correct documentation, and IP.
Yeah. I
Sorry,
think very
Devansh,
important.
Can I
Yeah,
add a point
please.
here? So we are basically an angel investment network and have invested in more than 110 companies, more than 250 crores. This is the work we do day in, day out. So I thought like I will give my bit as well actually. So as Praveen mentioned, obviously founders are the most important thing when you look at investment. But as startups, I think now, as there is a lurking danger that the angel investment is going to die, as startups, you need to be very careful to ensure that you are able to show exit to the investor. The investors are ready to invest if there is an exit available. They are not ready to invest only as a money invested and then forget about it. No, that angel investment period is gone now. Now people are really looking at exits. They are really looking at business as business and not as an angel investment. So I think now what we consider when we look at startup is, are there going to be exit option available in 3, 4, 5 years down the line? It may be less, more, that's a separate point, but that is number one. So that is one important thing apart from founders. The other important thing actually is, I think, and it is, it's always never said, but it's the integrity of the founders. In the sense, if the founder takes kind of lot of salaries and then they spend money actually, that's not the kind of startups which the investors are interested. So as investors, we definitely try to look at the previous usage of money, what they have done, even with their own money or some other funds they have raised. So yeah, this becomes very important.
All right. Fair enough. I think very valid points made by you also, Anurad. And we've seen so many cases where due to compliance issues or due to corporate structure issues, companies have failed and they've seen a downturn, even though they've been doing good in terms of revenue, they've raised some good rounds. But I think this is a very important point that you bring across. I'd like to ask Arjun and Praveen also that you guys have raised funds, you all are running startups and companies. So there would be multiple times that you all would have seen difficulties in cash flow management and having some burns, burn rates going pretty high when funding would have been a challenge at that point in time. So can you give your perspective to new founders, how to manage their cash flow, how to make sure that their burn does not go super high, or how to manage their burn rates also, please?
So I think we are not burning. So
No, not right now, but maybe in the past.
no, we all our balance sheets have been in green so far. So as of October 2024, since we started in 2016, all our balance sheets have been in green. So I think that is the most important aspect, that say when you manage your business, yes, initially you are your spending, you might be investing in your product, till you go to the market, your products start getting revenue. I think you need to invest. But I think fund management is a very, very important aspect of the cycle, because you will have times where you'll be running short of cash, you will be running short of. I think that is a very, very important aspect, that where to invest. I think what Sagar added, that say, we have also seen that a lot of founders, lot of people, they start taking more salaries on their own, they start investing into things which are not even relevant, correct, at the initial stage of it. So I think people should go with their own gut feeling, with their own plan, rather than getting copying others, what others are doing, participating in non-profitable things initially.
So any one example from your business where you all have made a very smart decision? If you all had less funds, you all were profitable from day one. But if you all had less funds, for example, during any time, and you all had to invest in 2 to 3, you had options to invest into 2 to 3 categories or manner. But you all made a smart decision to invest in one place. Any quick example to the audience?
I will tell a very simple example, that say prior to 3 months before, we never invested into social media marketing and others, because that was not getting us any business. Our business is B2B. We are going to the banks, we are getting business. We didn't require any marketing, media spend or something. There was pressure from the investor side. Let's do it, let's go spend money, let's have the brand building activities and all. But I think we spend a huge amount. If say we are a payment aggregator, regulated entity, lot of players, if you see the Paytms and the PhonePes of the world, still burning, correct? They're still investing into the social media, marketing, branding, acquisition cost. So I think that's where we at the initial stage, we thought that anyways our acquisition is coming, we are already getting the business from our banks, our partners, why to invest into that? So yes, now we have cash flow, excessive cash flow, we are working on to it. We as per the regulation or certain things we required brand building, now we have started. We think now the time has come, we are doing it. So I think this is a very important aspect again.
Yeah, that's very prudent, I think, smart. Arjun, your take? And I saw, smile on your face when I was asking that question. I'm sure you have had some problems, and not like Praveen.
Not the kind that he has. I love his problems. No, I think because our business is so different, we have a hefty B2C element to what we do. I think you have to rationalize things a little differently. Like sometimes you have to help build your brand as well, in addition to doing everything else that happens in the back end. And I'll just, kind of give a small explanation of what I mean by that is, now I know this sounds a little unnecessary to put it in the way I'm going to say it, but I think the brands you pick tells you as much about you as it does about the brand, right? Like, it's what do I want to be associated with is the decision you make on the coffee, it's the decision you make on the jam, and sometimes it's about purely the intrinsic quality of the product. So it becomes this funny thing where you convince yourself, oh, the brand's so important, but you're spot on, right? Like, it's not in comparison to anything that's actually going to help grow the business. So if you can prioritize ads or listing fees in a retail business or anything that is going to help grow revenue, I think that is a smarter choice than chasing the brand, sort of play at the beginning.
Any example you can give where you made a wrong decision of investment in some strategy, but that did not work out?
I think this session isn't long enough. No,
any quick one, just for learnings for everyone here.
So I think one of the things that we did was we got carried away with like the template of what it's supposed to be, right? Like you think, oh, Google ads, you should be doing YouTube ads, you should be doing Facebook and Meta and everything. And then you realize, oh, but the YouTube did nothing for me at the beginning. Google, there was no search intent. So why am I doing 1 million Google ads, No one's come to my website, so how do I chase them with cookies? And then you just start figuring it out. It's like there's an order to which you have to do things, And even when you know this, you still get carried away because of exactly the same thing. It's like people will come and pressure you and be like, ye karo, wo karo, and they keep trying to tell you this is like the sexy thing to do. And I think we were early enough and lucky enough to make a bunch of our mistakes really small, and that really helped. And I think I make a small distinction in like the investment point, and I think there's certain things that feel like an expense, and I think there's certain things that feel like an investment. And as long as you're not lying to yourself, if you're putting your money into something that's an investment, even if it's going to pay off in the short term or long term, there's merit to that, you know, and people will appreciate it, whether it's investors or whether it's, you know, sort of business partners. But expenses is just like a black hole. Like, I mean, there's so many. It's like the number of people who have come to me and be like, oh, why don't you ask Moni Roy to be your brand ambassador? It's just like, why don't I ask her to take half the company along with me? You know, like, I mean, you've got to be able to do it. And if you spend your entire budget on getting Moni Roy, how are you going to make any content or run any ads? Like, you know, so it's just one component of a series of expenses that you're signing up for. So I think the idea is, whoever said it, like, just said, like, manage it as if, like, it's your money, and it's like, it's not like an investor's money, you're playing with house money. This is your money, and the investor is you, and you are him. Like, there's no round two, you know, if everyone in the market thinks you're some gadha, you know, like, so the idea is be sort of responsible and take money management really seriously, because it can be make or break in crucial moments.
Yeah, so I think very well put by both of them. You know, it's very important to, you know, make sure that you are responsible for the money that you're spending as a startup founder, because you are the custodian of that investor's money, right? वो मतलब अमानत में देके गया ऐसी बात है. And you have to make sure that you are making returns for them. It is not just to spend, you know, and, you know, keep it away. So you have to make sure that you're giving something back to them. So coming to you, Anuradha, you've worked with investors and startup founders alike, right? And you probably are that bridge when it comes to doing a deal or transaction, etc. How have you noticed the relationship between an investor and a founder change, you know, when you're dealing with both the parties?
I think it's changed a lot recently. Founders in the industries that we work in are very young. The youngest client I worked with was 16. He couldn't sign our engagement letter. His parents had to. But they're young, they're very ill-advised. And investors have understood this, they empathize with it. And what I've seen so far, I'll give you an example. We work with an investor who's a client in England. He's an angel, well, he's a retail investor, I won't really say angel. But he specifically tries to add value to the startups that he works with. So he will go, he invests in gaming clients only. So he goes to every gaming conference, he goes to every blockchain conference, he scouts for the startups that he wants to work with, and he particularly selects the ones where he can add value, where he can provide advisory for no charge, for no extra amount, for nothing taken from the startups. But the idea is that investors now want to provide value. They want to sort of use their skills to incubate these founders in the correct manner, connect them to the right advisors. A lot of our clients that are investors connect us to their portfolio companies. They connect their portfolio companies to the right people in marketing, to the right people in tokenomics, white papers. Because it's difficult to find the right advisor. You'll meet a lot of people who will make tall claims, who will string together a lot of very long words that actually mean nothing. And I think that's the problem that investors are trying to solve now, at least from my perspective and my experience working with them.
Sagar, your take?
I think at Jito Incubation Innovation Foundation, we have some very clear-cut guidelines actually. So we, first and foremost, we just don't invest. We say that, okay, if we are investing, let's say, a couple of crores of rupees, then our investors, along with us, to take that responsibility of generating that much business for that startup. So if we are investing 2 crores of rupees, then we take up a responsibility that we will give them 2 crores of business through our network. So that is number one. So that is one thing which has changed drastically, because earlier it was like, मैंने पैसे डाल दिए, अब आप जो करना है करो, अब मेरे को return दे देना. Now it's not like that. I am working with you. Second, I think just so that things don't go haywire, we always try to take a board seat or observer seat or a special invitee seat so that we are also involved in the business. It's not like, we are just having a very long distance relationship. We are having a really involved relationship. And the third important point, what I think we are trying to do, as I told you actually, is that investors definitely look for active exits. And that's where we always try to work with the startups, telling that, okay, the round 1 has happened, round 3 has happened, now what happens to round 1 investors? Can they have some exit actually? Because that's the way actually more and more money is going to come back to the startup if there is exits available.
Okay, coming to the exit point also, probably all of you guys can answer this. What are the current scenarios in which an exit strategy can happen for investors who've invested 3-4 years back? What are the options available today? Of course, it depends from business to business, but what are the exit opportunities available if a young founder is, going to watch this or listen to this?
So I think if you see over the last few years, the options have increased, correct? So there are options, say if somebody has invested as an angel investor, somebody at a later stage will come and give the exit. All depends, exit depends purely on how the startup is performing, correct? The most important aspect is that. So exits are not available to the startups who are not performing. So I think if the startup is doing good, the founders are doing good, I think exits are easily available to EA. So I think SME IPO has recently come up. A lot of people have EA listing IPO. We have seen, correct? So this year it is I think full bouquet of startup IPOs, correct? So I think multiple options are available. I think that's not a problem. But I think the most important
when
aspect
should a
is,
founder, when should an investor look for an exit? What is the ideal time frame?
So I think it depends on the investor itself, correct? So what is their horizon, correct? Somebody would have invested with a 2 years, 3 years horizon. Somebody is a very long-term investor. They want to keep on. I know a lot of people who have already are sitting on in some of the startups. They are sitting at 30x, 40x, but still they are not exiting because they believe they can go far away from it. So I think exit period or the timeline depends on the investor psychology and differentiate between investor to investor.
Arjun? Please go
question.
Yeah.
So on the exit side, I think the idea is, and it's not just for the founder, right? It's also for the investor. So in a more B2C sort of retail type of business, I think the types that you see is like one is say a strategic exit. So where a massive sort of like player will come in, and then that typically works when you have limited numbers of product lines yourself and you integrate within a larger ecosystem which is complementary to what your strategic is already doing. Another version of this is, say, the SME IPO, which is brought up, which is if you are really diversified and there's no clear integration into a strategic because you're doing all the same things that they're already doing and they don't want to have 2 oils, 2 grains, 2 jams, 2 sauces. Like the idea is maybe it's not a perfect fit for a strategic in that sense. Of course, there's multiple layers to this, but like in a situation like that, you may be best off exploring an SME IPO. And then there's, of course, like a whole bunch of other ones where you can creatively look at ways to kind of rejig what you're doing and branch off sections of your business. Now, I don't think we've had the luxury to think in that direction yet, but the ideas popped up to us where because we're doing our own manufacturing and because we've got our own B2C brand, it's been proposed to us, for example, that there could be a version of the future where the manufacturing arm does its own thing and has a separate set of investors for buyout, whereas the B2C arm has a sort of different kind of integration. So, I mean, there's a million ways to do this. We are like 2,000 years into the business game. People have been doing this forever and figuring out how to, assimilate businesses, companies, entire countries, so there are versions out there. I think the idea is there should just be, as you always said all through this panel, and I love that, is there should be real value. You should be actually worth something to someone. And as long as you're doing well, someone will see the value in it.
Yeah.
Even you may not know where it's going to come
Yeah.
from, but it's there. And I think the focus should be less on anything, sort of like nebulous. But I think the idea is focus on the real things, focus on the dhanda, grow a good business. And then I think the investors sort of appreciate that you've done right by them.
Fair enough. Sagar, so due to shortage of time, I'm going to quickly ask 2 questions. First to Anuradha. How do changes in government regulations and policies impact startups and their ability to raise funds?
Tremendously, if I was to give a short answer. Depending on the industry you're in, an investor may have reservations if the policies and regulations of the country don't support it. I work with a lot of startups in the blockchain space, in the AI space. And I can tell you one thing is for sure, that we don't have clarity of regulations right now. Investors shy away. And even the investment route, right? We do a lot of token sales, which is a new method of fundraising where a startup that sort of has a utility platform, or rather you have a gaming platform, if you have a social platform, and you can launch a token that offers utility. It's a great way to raise funds. But the issue is that in India at the moment, it's not recognized. So all of the founders that are here have to go and set up offshore in jurisdictions like BVI, Cayman, Panama, and we do these setups regularly. But because of the lack of regulation and policy in this industry, it is driving a lot of innovation outside the country. And that's very unfortunate. The government in August this year said that they're going to release a discussion paper for crypto by September, where in October now nothing's come forward. There are, of course, a lot of incentives for startups in general, but I still think we're just sort of in very shallow waters with this right now. We need to wait for clarity. We need to wait for better incentives, not just for startups to, start up, but for investors to come in and invest.
Okay, fair enough. Last question before we open it up to the audience also. So that's for you, Sagar. What kind of future trends do you see shaping up in the startup ecosystem and fundraising in general?
Okay, so we have clearly seen 3 phases actually. So I think the first phase of startup was based on pure valuation. Number of customers you have, each customer is valued at X rupees or dollars, and then like valuation of the startup, and people invested. The second phase is come right now, which is actually more people look at real revenue being generated. So it's like, what kind of revenue you are generating. I think the third phase is going to come profits. So actually people will want to invest in profits actually, and not like just have a valuation or a revenue game. I think that's the future what we see actually, that valuation moving to revenue, moving to profits. I think that's really going to happen in a very short span of time. And that's the reason why, you see the funding winter, what we call last 1.5 years, because in pure valuation, people realize that nothing is coming in our hand. So what's the point of valuation?
Consolidation phase. Any particular sector that you're excited about as an investor?
Yeah, so we are sector agnostic actually. We are absolutely sector agnostic fund investor. So, and we are backed by 800 angel investors. So wherever money is, we put our mouth.
Okay, so Sagar Bhai has marketed Jito very well throughout this conversation. That's very good. Let's open it up for the audience. If you guys have any questions for all the 4 guests out here, panelists out here, please do shoot. Anyone, or we can give the mic also to them, I guess. Anyone questions? Please raise your hands. On startups, on fundraising, fund management, venture capital, investment, business. Yeah. Any questions, guys? No questions? Come on. On, y'all have come for the trade fair then. Okay, I don't think there are any questions.